Welcome back to our channel, where we bring you insights and analysis on the latest market trends and news. Today, we have a special guest joining us, Thomas Hayes, Chairman and Managing Member of Great Hill Capital, who will be sharing his views on the current state of the economy. In the interview that we will be reviewing, Thomas was hosted by Rachel Akufo. But before we jump into the interview, make sure you're subscribed to our channel and hit that like button to stay up to date with our latest content. Now, let's get started. Rachel opened the interview with a statement and asked Thomas this: "It's been a roller coaster year so far, with January starting strong, February being disappointing, and March uncertain with the upcoming jobs data. What market catalysts should we be looking out for this month?" Thomas responded by addressing some of the key myths that are keeping people out of stocks and why they may be missing out on opportunities. As mentioned, this has already been a roller coaster year because obviously, we were off to the races in January, disappointed in February, and now March is really sort of circling the drain here, figuring out what's going to happen, especially with this big jobs data that's coming out. Thomas added, there's a lot of pessimism coming in, but there are 3 key myths out there right now that are keeping people out of stocks, and I think at exactly the wrong time. First and foremost, stocks don't go up during tightening cycles, aka don't fight the Fed. How many times have we heard that? But if you look back over the last 4 tightening cycles since 1994, the stock market is up on average 7.8% during the tightening period. Another myth within that is that tech can outperform, but if you look at the data, tech and REITs are 2 of the top performers during those periods. The second myth that's been out there is that the stock market must go down when earnings are coming down, and history doesn't support that. Since 1930, in years where earnings are up year on year, the S&P does about 10.2% including dividends. And in years where earnings are down year on year, the S&P does 9.8%. So the key is not timing the market, it's time in the market. And the final myth, and this is the big one, Rachel, I'm sure you're hearing it all the time. You can't be in stocks with super high inflation. However, in periods of rising inflation, the S&P goes up by an average of 5.5%. Not so great. But in periods of falling inflation, the equity indices go up on average 14.7%. And I don't know about you, but I don't need a magnifying glass to see that since last July, inflation has come down every single month. We are in a falling inflation environment. Rachel commented that these are some very well-established myths. And when you think about the fact that this isn't your typical period when you think of a recession, this is a Fed-led recession, and so people are trying to sort of balance what they know from history with their usual market expectations. After that, she asked him this: "So, what should people be doing differently from the crowd? Where do you see the opportunities?" Well, I think they should be like George Costanza from Seinfeld and do the opposite. If you remember, everything started working well for him when he went against his normal instinct. And what's the instinct? What is the crowd doing right now? Well, we see from the data that equity flows out of equity funds have been the highest in the last few weeks since the spring of 2020. And to jog everyone's memory, in the spring of 2020, we had that violent rally of the lows. In the March 2020 lows, we rallied about 40%, and all of the commentators were coming out and saying we were going to go back and test the lows. We don't have a vaccine. We're going to break the lows. And what happened? We went up another 50 instead, Thomas explained. In the world of finance, we currently have negative earnings and an inverted yield curve. However, despite this, we believe that pushing higher against a wall of worry is the maximum pain right now. Last year, we crashed in anticipation of the slowdown, but this year, we anticipate a rally in anticipation of the earnings recovery next year. Unfortunately, everyone is buying VIX call options at a record pace, which is like buying insurance for a house that already burned down last year. A bad move. If we look at the Bank of America Global Fund Manager Survey, managers are currently the most overweight in bonds relative to stocks since the pandemic lows in March 2020 and the great financial crisis lows in March 2009. However, these were times to buy equities, not bonds. The stock market does not top when people are overweight bonds. It tops when everyone is overweight equities and you run out of marginal buyers. We are nowhere near that right now with cash levels and funds coming out of equity. So we believe there's a lot of opportunity in the market to buy high-quality companies that are on sale. Moving on deeper in the interview, let's talk about bonds. Regarding bonds, we understand that a lot of people are looking for the safety that they're used to, but we believe that on a company-by-company basis, you can find high-quality businesses on sale. People are very pessimistic about recovery, and we think they're underestimating what's going to take the market up. The second largest economy in the world, China, is reopening after 3 years of stop and start and major lockdowns, and this is a positive catalyst for the global economy. Since they opened, the composite PMI has been higher than pre-pandemic levels of activity. This rising tide is going to lift Europe and lift S&P earnings, and it's just getting started. Even today, we saw box office tickets for the movie theater up 12% year-on-year in China. This is a positive catalyst for the global economy that very few people are putting weight on because it's been offline for so long. In terms of inflation, ECB Chief Christine Lagarde has said that it is still a global monster, but we believe that China reopening story is a positive catalyst for the global economy that very few people are talking about. However, some people are wondering whether it will be a double-edged sword, fueling inflation while also helping with demand. However, our experts suggest that China's demand was down a little bit when they were shut down, and now we're seeing US rig counts creeping back up to pre-pandemic levels. This means that US production will offset any potential inflation, making it a positive catalyst for the global economy. Moving on, we're always on the lookout for high-quality businesses that are marked down. While Amazon is still a good option with a 55% discount on its recent highs, we're also considering 3M, which may seem like a boring company but is currently trading at 11.5 times forward earnings compared to its historic multiple of 17 times. Even its great financial crisis low multiple in March of 2009 was 14 times. It has a legal overhang with 2 lawsuits, but one of them was recently resolved in favor of the company, which is a positive catalyst to help alleviate some of the litigation overhangs. They're also doing 2 tax-free spin-offs to unlock value for shareholders, so we think that's going to be a positive one moving forward. Furthermore, we've observed that everyone is buying VIX call options at a record pace. While this may seem like a good move, we caution that they're buying insurance for a house that already burned down last year. Also, according to the Bank of America Global Fund Manager Survey, managers are the most overweight bonds relative to stocks since the pandemic lows in March of 2020 and the great financial crisis lows in March of 2009. We believe that this is a good time to buy equities instead of bonds. In conclusion, while it may be tough for some people to adjust to the current market trends, we believe that there's a lot of opportunity to buy high-quality companies that are on sale. Despite the pessimism about the recovery, experts believe that China's reopening is a positive catalyst for the global economy. So, keep your eyes open for good deals and remember that a bit of boring might be just what investors need after a year of volatility. Thanks for tuning in to today's financial news update. Don't forget to like and subscribe. See you in our next videos.